Stop the noise. This is an alpha level market alert. Ignore the distractions, tune out the chatter. We are witnessing a structural shift that will separate the beta chasers from the alpha hunters. This is not about intraday volatility. We are talking about a once-in-a-decade capital migration unfolding in real time. While retail investors are still scanning NVIDIA's charts for a double top breakout, the tectonic plates beneath institutional portfolios have already cracked. Core event Meta, Mark Zuckerberg's flagship, has just dropped a strategic nuclear bomb in the AI arms race. They've officially confirmed a multi-billion-dollar shift in capital expenditure from NVIDIA to Google's TPU architecture. Let's translate this in institutional terms. This is the highest level supplier substitution. It's not a tweak in operating expenses OPEX. It's like a wartime commander switching core military contracts to a rival. This is a seismic signal. It means NVIDIA's seemingly impenetrable moat has been breached from the inside by its largest enterprise customer. The most expensive cognitive bias on Wall Street is "this time is different." That linear thinking buried Nokia. Today, the armor of big tech has its first crack. The question is, will you misread this as a buy the dip trap or recognize it as an exit alarm? This briefing delivers hard data from due diligence. We'll deconstruct macro liquidity, TCO, total cost of ownership economics, and the flow of smart money to argue why Google is emerging as the new AI hegemon through vertical integration. Before touching tickers, calibrate the macro compass. For the past 24 months, NVIDIA's premium was driven by one force: high interest rates. When the Fed tightens liquidity, capital flees risk and chases predictable cash flows. Who delivers that? The pick and shovel provider, NVIDIA. This was classic defensive positioning, but the wind has shifted mechanically. In mid-November, Fed Governor Waller signaled a clear pivot. Swaps markets now price in an 81% probability of a December rate cut. This is no longer speculation, it's consensus. That means the liquidity floodgates are reopening. As the cost of capital falls, money becomes aggressive. It no longer settles for one-time hardware profits. It seeks platforms with closed-loop ecosystems and exponential growth potential. Analogy: for the last 2 years, we've been sheltering in NVIDIA's bunker. Now the storm has passed. Capital is stepping out, looking to build infrastructure on fertile ground. That ground is the AI application layer, and Google is the developer with the full-stack blueprint. This is the macro backdrop for Google's valuation re-rating. It's a conglomerate of search, YouTube, and cloud infrastructure. We're shifting from investing in the brick maker to investing in the landlord collecting rent. Add in reduced geopolitical risk premiums from US-China dialogue, and institutional flows are moving from pure hardware to platform giants. The migration has only just begun. The market's biggest misconception: most compute equals best business. This is engineer thinking, not capital thinking. In the enterprise world, the only two variables that matter are efficiency and TCO, total cost of ownership. NVIDIA's H100 is a performance beast, a Swiss Army knife. But in pursuit of universality, it sacrifices energy efficiency, making it extremely expensive. Google's TPU, that's a laser scalpel. As an ASIC application-specific integrated circuit, it strips out all redundancy and is built solely for machine learning. Let the data speak. In AI inference workloads, Google's 4th Gen TPU delivers 30% lower latency than the H100. On Google Cloud, operational costs drop by up to 25% per year. This isn't just cost savings, it's freed up R&D budget. For giants like Meta or OpenAI burning billions annually, a 25% cost reduction is a fiduciary imperative. It flows straight to the bottom line. That's the balance sheet logic behind Zuckerberg's decision. But the deeper battle is in ecosystem positioning. NVIDIA's model is hardware plus CUDA. It depends on downstream customers to monetize. If those customers internalize, build their own, NVIDIA's moat evaporates. Google runs a software-defined hardware loop. It controls the endpoints, search, YouTube, Android. The Gemini model is embedded across these touchpoints, feeding real-world usage data directly into the next-gen TPU design. This is the ultimate feedback loop. Every click optimizes the chip. Google is both the biggest miner and the shovel maker. This self-reinforcing ecosystem is physically impossible for NVIDIA to replicate. Result? A business model leapfrog. Channel checks show rising inventory days for H100, a red flag. Meanwhile, Google is executing a 3-pillar strategy. 1. Supply TPU to Meta hardware revenue. Rent TPU cloud compute infrastructure as a service. Boost ad conversion via AI core business upside. In Q3 2025, Google's AI-related revenue surpassed $20 billion with a 68% gross margin. Throughout November, a clear divergence in flows emerged. Google saw sustained inflows while NVIDIA experienced outflows. Sovereign funds and pension plans are rebalancing. Algorithmic trading is executing the order, shift capital from old cycle winners to new cycle challengers. The Elegant Hedge, Broadcom, AVG. When the TPU news leaked, Broadcom's stock gyrated, a knee-jerk market reaction. But on November 25, Broadcom surged 11%. Why? Smart money completed the repricing. Broadcom is the core IP and manufacturing partner for Google's TPU. JP Morgan's research estimates Google's TPU project will generate over $10 billion in revenue for Broadcom in 2025. This is the toll booth model. You don't need to bet on which car wins, just collect fees from every vehicle that passes. Instead of crowding into the crowded NVIDIA trade, capital is flowing to the real beneficiaries, Google and its key enabler, Broadcom. Execution strategy. No position, no voice. This is not financial advice. It's a structural allocation framework. Core principle, no leveraged bets, no gambling. This is about positioning. 1. Conservative play. Broadcom, AVG. As the arms dealer in the TPU thesis, it offers defensive valuation. PE to 22x. Buy zone. Wait for a pullback to $345 near the 5-day moving average. Hard stop $330. Ideal for capital-seeking alpha with risk aversion. 2. Aggressive play. Google Plus, Meta combo. Go long the supplier, Google, and the major adopter, Meta. Look for entries near $300, a key support level. Watch the $600 psychological level. Risk management. Use trailing stops. Never let a winning trade turn into a loss. 3. Passive play. This is 1. Increase exposure to tech ETFs heavily weighted in Google and Broadcom. Time in the market beats timing the market. The worst move? FOMO buying at the top. Patience wins. Wait for confirmation. Trends are your ally, but only if you don't enter when they're exhausted. The real opponent, your cognitive biases. Humans instinctively extrapolate linear trends. NVIDIA was a winner, so the brain assumes it will always be. That's recency bias. It makes you greedy at the top. I'm asking you to do the counterintuitive. Exit the old narrative. Enter the new one. It will feel uncomfortable. But history's greatest returns go to those who bet on the future before it becomes consensus. Business evolution is ruthless. 20 years ago, Nokia had unassailable hardware. Then Apple arrived with touchscreens and the App Store. Nokia didn't lose on quality, it lost the paradigm war. Nokia's Minsky moment came when developers migrated to iOS. Today, the AI space is at the same inflection point. NVIDIA is a great hardware company, but if it remains only a hardware company without building an application moat, it faces existential pressure from full-stack giants like Google. This isn't alarmism, it's the rhythm of technological disruption. Are you still holding NVIDIA or starting to rotate into Google's ecosystem? What's your conviction level for 2026? Share your thoughts in the comments. Stay sharp. Manage risk. This is the moment for alpha hunters.